Welcome back, everybody. So today we are going to be checking out Elon and Trump just in regards to the economy and markets. Now, I think they are currently doing a secret plan and they're not really fully disclosing it to the public for a few different reasons, because I think it will have large implications on the stock market. So let's pretty much get straight into it. I really do think that this is incredibly important to fully understand, because it will give you a much better understanding of where we currently are from a fiscal point of view, from a market point of view, and from a government's point of view. Obviously, when you start to zoom out and you don't really look at the headlines, obviously what is going on with Trump, what is going on with Elon, and you really start to look at the implications of what is really going on, you really start to get a very good understanding. Now, to basically get into this whole thing, we need to look at the income from the United States. So the US basically generates $4.92 trillion in tax revenue. Now, of which 90% basically comes from the private sector and 10% basically comes from the public sector. Now, from an entitlement spending and military spending, the US is basically spending $3.9 trillion and about $875 billion in terms of military spending. Now, when you deduct the entitlements from the tax revenue, you are basically left with a net fiscal balance of about 127 billion. Now, what you need to take into consideration, what I think is massively important, is that the US has $35 trillion in debt, what basically needs to roll over onto the current rates, what is 4.2% interest rates. Now, obviously, 35 trillion at 4.2% interest rates gives you an annual interest payment on the debt of about $1.5 trillion. Now, it doesn't really take a genius to really understand that a net fiscal balance of about 130 billion would not pay off $1.5 trillion. Now, they really need to start to bring down the interest rates. Now, what I was talking in my previous video is that the US government basically has to refinance $7 trillion of debt in 2025. Now, when you look at the debt distribution of this debt, you can basically see that it's about 40% of the total debt needs to be refinanced in the next couple of months and next couple of weeks. Now, what I have done over here is I've basically taken that $7 trillion and I have applied a interest rate to that $7 trillion, so you can see what the interest payments, the annual interest payments on that debt would be. Now, obviously at the moment, at 420, obviously, at 420 interest rates, we would see that the annual interest payments on 7 trillion would be about 300 billion. And at 3%, it would be 210 billion. At 2%, it would be 140 billion. And at 1%, it would be 70 billion. Now, if we take the net fiscal balance and we basically subtract the rate, what obviously is 4.2%, 3%, 2%, 1%, you can start to see we get a very different picture in terms of what the net fiscal balance of the United States would currently be, and why it is massively important that the rates on the 10-year note comes down significantly. Now, obviously, if it rolls over to 4.2%, the net fiscal balance would be minus 170 billion. Now, obviously, this is why I believe Elon and DOGE are looking at entitlement spendings. They're looking at spendings just in general to try and save as much as possible. Now, what I have done is I have taken the DOGE clock from the US National Debt Clock.org. I'll obviously put this link in the description, but I don't really know how accurate this number is, but I've basically just said I basically just rounded this number up to about 190 billion. Now, if we take into consideration the savings, what Elon and DOGE are currently doing, and we add that number back into the net fiscal balance, and then subtract, obviously, the annual interest payments on $7 trillion, we basically get $27 billion what are currently left over. Now, this is in a perfect world. This is obviously if tax revenue is not impacted. Now, obviously, there's a lot of news going around at the moment, especially when it comes to trade tariffs. Now, I really do understand why you would want to put trade tariffs on, because I think trade tariffs would bring in a lot of, let's say, tax revenue very quickly. Now, the long-term implications of tariffs would be detrimental in terms of tax revenue just in general, but it does really help in terms of bringing tax revenue in very quickly. Now what you can see here is that as the interest rates basically come down, you can see that there's massive relief for the US government. And what you can see also is that I've just kept the 190 billion quite static throughout, obviously, the next couple of weeks and months. And now, obviously, you could imply that as Elon and DOGE find more and more wasteful spending, obviously this number would massively increase, what obviously is absolutely true. Now you can start to see that as interest rates come down, and obviously Elon starts to save the US government a lot of spending, you can start to see it becomes a lot easier in terms of managing the overall national debt. Now, why I think the interest rates are not currently coming down is because now the Federal Reserve has a mandate, what is basically maximum employment and price stability. Now, with unemployment at about 4.1% and inflation at about 3%, there is no real reason for them to drop the rates. They don't really have a reason from a mandate perspective, because obviously unemployment is not massively shooting up and inflation is not massively shooting up. So they are kind of in a bit of a tricky position. Obviously, the Federal Reserve is fully aware that the US government obviously needs to refinance a lot of this debt onto these higher rates. And I think it's very, very clear of why we start to see the market to come down, because as the market obviously starts to come down and let's say unemployment starts to go up, the Federal Reserve can obviously step in and obviously create a reason to bring down the interest rates. And I think the desired interest rate would be around 3 to 2%. Now, obviously, there's going to be a lot of debate around how much the Fed cuts. And obviously, I think that is very dependent on how high the unemployment rate actually goes and obviously how high inflation goes. So obviously, if they massively reduce the rates at the moment where the current stock market is at, it doesn't really look that good, because it looks like they are trying to obviously prop up asset prices when you start to look at the overall economy from what the Fed is currently looking at from a unemployment and an inflation standpoint. They don't really, like I said, they don't really have a reason. So they really need to create an artificial reason in terms of cutting the rates. Now, I do think, like I was saying in my previous video, I think this is going to happen sooner rather than later. And like I was saying, like the unemployment rate is relatively low. The inflation rate is relatively low as well. And when you start to look at the markets, obviously we are seeing quite a large correction on the NASDAQ and S&P. Now, just to give you some more context of what this yellow line currently is. Now, this is currently the net liquidity of global net liquidity around the world in terms of central banks. And I've basically overlaid the net liquidity, the global net liquidity onto the NASDAQ. Now, what you can pretty much see now, let's just bring this down a little bit and let me just... Now, what you can pretty much see, what I always find very, very interesting is that you can start to see these large divergences. So as the market starts to correct, we then start to stimulate, we then start to print money. What you can see is that throughout history, we can kind of always see that the Fed pretty much steps in and prints the money to obviously save the market. And at the moment, when you start to look at the net liquidity and obviously overlay it with NASDAQ, we see a massive, I mean, I can't even get it onto the chart, but we can start to see a massive divergence. And like I was saying, like market goes up, obviously liquidity goes down, and then obviously market eventually follows and obviously touches net liquidity. The Fed comes in, starts to stimulate. And again, I mean, obviously this, you can check this throughout history and we can always see these divergences. Now, obviously we have a massive divergence. Now, are they really going to stimulate? Because obviously they're in a very, very difficult position, right? Because obviously if they do stimulate, it massively distorts asset prices. Everybody thinks that we're going back to risk on. But obviously if the market starts to crash, this would have large implications on the unemployment. But obviously it would bring inflation down. So obviously it would give them the excuse in terms of cutting the interest rates. Now, I really do think that Trump and Elon are fully aware of all of these numbers here. And I think that it's on purpose that Trump is kind of throwing his weight around a little bit in terms of talking about tariffs, talking about this, talking about that, because he really needs a reason. Now, I also just want to say that I can really start to understand why the US doesn't really want to advocate for war, because it would massively bloat their current expenses. Now, obviously, Europe is pushing and wants to escalate what is going on in Europe, and obviously, I don't think that is in the best interest of the US. Now, obviously, as asset prices start to come down, or what I'm assuming, asset prices will start to come down, the market starts to come down, and obviously unemployment starts to go up, I really do think that Elon and Trump are going to have probably one of the worst times from a reputation standpoint. But the thing is, I really do think that this is required in terms of bringing down these interest rates, because the Fed is not going to cut just because Elon says so or just because Trump says so. I think they will be looking at unemployment numbers and inflation numbers. And obviously, if that means reputational damage from a Trump point of view, from a Tesla point of view, from an Elon point of view, I think that is what's required. And I don't think many people are actually paying attention when you start to look at the bigger picture. They are just getting very emotionally charged, especially when it comes to asset prices, when it comes to markets, and they don't really start to look under the hood. Now, obviously, this could all just be speculation, and I could be massively wrong on all of this. And yeah, this is just how I'm currently thinking about the current situation.